Silver Report Uncut. If you haven't, be sure to follow our Telegram channel. It's just t.me/Silver Report. Now, there's all types of crazy chaos going on. The markets are falling apart. Jerome Powell, his recent statements, they really tore things up. It almost seems intentional. There's also a whole lot of chickens and turkeys that have begun perishing. This is as a result of this new bird flu that is wreaking havoc on the U.S., and a lot of people aren't paying attention. But we're not even going to start there. We're going to start at what's going on with New York City's real estate market. Now, we covered several times how it was going to be bad. Of course it was going to be bad. But one of the largest hotels in New York City, it is selling at a massive loss. We're talking about half the value of what they paid for it in 2006. If anybody's been paying attention to what's been going on in real estate prices, they have been on an epic rise. It's been insane. They've risen to new highs just about every month, every time the data comes out. The sale is actually the city's third largest hospitality trade in over 2 years. The 51-story hotel is New York City's third largest by room count. The host was struggling to sell the property at the price it purchased the hotel for long before this crisis. They were asking around $550 million in 2018. In 2020, Host admitted that the Times Square Sheraton's value, it had sunk even lower to $495 million. So the fact that they sold it for even less now, it's quite disturbing. And this has a lot to do with the fact that there's going to be an epic rise in the amount of available real estate in all of these major cities, New York City in particular. We've covered several times in this program how that the back-to-office workers, they had nowhere close to recovered. They were running somewhere around 25%. So think about that. A city that was brimming with activity, feet covering every inch of sidewalk in the entire place. And suddenly, they shut everything down. Now, every day you will see all types of workers heading to their various jobs on the subways and the taxis, moving all over the place. But then suddenly everything shuts down. They close down all non-essential businesses. Throughout the course of this, a lot of these companies begin thinking of new ways to move over to work from home, to reduce their office space footprint. By the time everything got back opened, well, that's what they called it, only 25% of these workers, they actually came back into the office. And this was going on just as recent as 2 months ago. They reported that only 27% were back in their offices. That is devastating. So suddenly, all of that real estate is worthless. It used to be very expensive, but this is the reason we see so many vacant buildings that it's beginning to look worse than Detroit. We could look like a very, very different country by the time all is said and done. So the market has been a total wreck out there. You would think the Federal Reserve has either lost their mind or they really just hate to see the economy recover. The Fed, they typically dominate the market actions, of course, and they definitely did so yesterday. The action in stocks and bonds, a reaction to a very hawkish tone that was consistently narrated by Jerome Powell. There was also Raphael Bostic and then Tom Barkin. Bostic said he's not wedded to only move rates by 25 BPS. And Bostic said the Fed should get moving quickly on their balance sheet. Barkin, he said he can move at 50 BPS clip again to tame the inflation, of course. And Barkin also said we could move faster. Already, this is impacting the bond market. Jerome Powell came out with his prepared remarks at a Q&A. He confirmed that he was open to a 50 BPS rate hike. And he said, quote, "We may well conclude that we need to move much more quickly." This would suggest a much more aggressive quantitative tightening in 2018 when he said, "We are a long way from neutral." And this sparked a plunge at that point that turned him into a super supportive person of the stock market and this whole rescue the world ideology. The market reacted very strongly to this. It was selling off pretty fiercely, and then there was a buying panic in the last few minutes of the day, and the S&P somewhere landed around even. The yield curve inverted at numerous points. This was screaming that the Fed will not make it to their target and will obviously admit to their policy error. As the more the Fed hikes rates in the short term, the more immediate rate cuts are being priced into the market soon after. Treasuries, they were dumped across the curve, and the short end was underperforming dramatically. The 2-year, the 5-year, they were up almost 50 BPS on the day. The 2-year yields, they soared back around 2% to their highest since May 2019. Today was the second biggest yield jump for 2 years ever since June 2009. Jeffrey Goodlock from Double Line, he said, quote, "The 2-year U.S. Treasury yield is up 86 basis points over the past 3 weeks alone. If that pace were to continue, the 2-year would top 17% by March 1st, 2023. S&P also rallied to its 200 daily moving average and fell back. The Dow fell back below its 50-day moving average, as did the Nasdaq. In the small caps, they managed to hold above that 50-day moving average. Crypto, it was lower, with Bitcoin fading back. And oil prices, they soared today. It was interesting because hedge funds, they did a whole lot of selling right before oil prices began to rebound. WTI was back above $110 a barrel, and there were fears of these sanctions that were going to be going out, and anxiety caused by the Saudis raising the threat of escalating problems on the energy infrastructure of the Houthis. What's interesting is that the cost of insuring against a default in emerging market nations, it rose to the highest level since the beginning of this crisis in 2020. And gold, it performed pretty well today. It did manage some gains. There was a huge jump lower earlier at the U.S. equity cash open. And we also see the current market's analog with 2018 is still loosely holding. And we suspect this path lower is where we're going to end up as investors realize that until further downsides are reached, Powell is going to keep pushing this hawkishness to 11. Jerome Powell, he has an intention to cause a recession. And as long as you keep ignoring the fact that he's no more going to be supporting you and supporting these markets, you're going to be in for some real pain. Now, I wanted to talk about what's coming out of Morgan Stanley. It's very, very interesting. The man is coming out as just about a phenom in regards to predicting the market action compared to all of these other jackasses. They're out there telling everyone to buy the dip every time there's a dip, and it keeps getting lower and lower and lower. So we'll begin here. JP Morgan, their Marko Kolanovic, he just spun again his broken record, and he said, not just once, but twice in the past week, clients need to buy the dip. Something he's been saying every single week throughout the entire year. And he's getting a really bad image, I'm sure, because he's urging his clients to continuously buy while they keep losing and losing more. But JP Morgan, they keeps digging in this perma-bullish idea. Morgan Stanley, however, they have the most bearish strategist on Wall Street, Mike Wilson. He is calling it almost exactly how it is. The rest of Wall Street is desperately trying to convince everyone to keep their money in the stock market, especially keep their money in their possession. Now, Mike Wilson, one day after reminding clients that the current cycle is getting late and will burn out far sooner than expected, he warned that the U.S. economy could be in for a downturn as soon as 5 months from now. That means a recession. He's out with another note in which he takes the exact opposite view of Kolanovic. He said that while the rally in equities over the past week was one of the sharpest on record and could go a bit higher, led by the NASDAQ and small caps, he remains convicted it's still a bear market. And we would use this strength to position more defensively, meaning he's leaving you holding the bag. Quite wise at this point. He's going to take advantage of this opportunity in the market's rise to sell and reposition themselves more defensively for this coming downturn in the economy. Those that missed what he said on Sunday, Wilson reminded his readers about a note he published a year ago, arguing that this cycle would run hotter, but shorter than the prior three. His view is based on the speed and the strength of the economic and the earnings rebound post the 2020 recession. Now, the thing is, this recession was something where the credit cycle never came to an end. The return of inflation after a multi-decade absence, an earlier than expected pivot to this hawkish Fed policy. In light of this, last Friday, Morgan Stanley published an update that shows developments over the past year support this call. The U.S. GDP and earnings, they've surged past prior cycle peaks. They're now decelerating very sharply. Inflation is running at 40-year highs. And the Fed, it just has executed the sharpest pivot in policy we've ever seen. In just 22 months after the end of the last recession, which anyone who would realize it never ended the prior business cycle because debt never dropped, it spiked. But Morgan Stanley's cross-asset team, they said the U.S. cycle model is already approaching prior peaks. But stepping away from the economy and shifting